Welcome to Consumer Lending Perspectives, a podcast where we talk to financial industry leaders about trends in consumer assets, underwriting, performance, customer acquisition, fraud prevention, liquidity, and more. Hosted by Jeff Bogan, CFO at Upgrade and FinTech veteran. This show delivers key insights on the topics that matter most to financial executives.
Welcome back. I'm your host, Jeff Bogan. Today's guest is Vadim Verkhoglyad, dv01's head of research, who authors analysis on consumer credit and financial data. He started his career at Fitch Ratings, and after 12 years at hedge fund Tricadia Capital, he has extensive background on data, performance analysis, structured credit investing, and research, and capital markets overall. He's a data guru. DVO in general provides loan-level consumer credit data, research, analytics for lending markets. Welcome to the podcast, Vadim.
Hey, thanks for having me, Jeff. Glad to be here.
Good. Why don't we start with just how did you get into consumer credit originally? You clearly are very strong at data. There's a lot of data in consumer credit. It seems like a natural home for someone who's interested in that. But how did you find your path there?
Sure. I started investing. We started at Tricadia investing in the structured mortgage-backed market in the lead up to and the aftermath of the global financial crisis. And you learned pretty quickly just how much data there is available in terms of being able to underwrite credit and being able to understand what the credit lending cycle is, how it's driven, what factors, small or large, can impact behavior. And I think in large part it was a response to perhaps the lack of data transparency, or in some cases, the lack of accessibility to data transparency. The consumer unsecured universe largely started up being quite a bit more open kimono, in the sense of you didn't have the security of the attachment to the property, so you could easily recover the property in case of a default. But instead, what people were provided as investors is a rare insight into underwriting, because you were given pretty much a digital file of the entirety of the borrower's credentials, so to speak. Almost the way that you would think of credit card underwriting being done at banks. And at that point, investors were able to make the choice of saying, okay, well, I don't have the security of the home. And this was also quite a few years after the global financial crisis, where you really started to see, on a macro level, households really adjust their borrowing, spending, and balance sheet patterns entirely. It was a sea change. And from there, you could pretty quickly see the opportunity of effectively short duration, relatively high yield in a ZIRP environment loans, which happen to have a relatively reasonable default range, so to speak.
Yep.
So we at Tricadia got involved pretty early. We were participating in some of the earliest securitizations back in 2016. We also bought whole loans. We evaluated all the major platforms. And after I left Tricadia, I realized that, hey, this market is very dynamic. It's still growing. And it has the potential of targeting more and more borrowers in a larger and larger portion of today's really, I would say, still the legacy market still has quite a bit higher interest rates than some of the new products out there. And the more that the digital lending space can penetrate those borrowers, the more high touch, high credit APR borrowers you can touch, the better kind of everybody is overall. Right. So that's why the space always is interesting to me, both from an investing perspective, from a research perspective, from a data perspective, because it is a lot of transparency.
Yeah, it's interesting. When I started in fintech in 2012, when I was running the investor group at Lending Club, I think one of the biggest issues was just simply data and access to data for institutional investors. Everyone was reporting data in different formats. Everyone had different data definitions. And I remember when Perry was starting dv01, like the problem he was trying to solve is just give people data they need to make decisions in a way that has credibility. And so it sounds like that's a continuation of kind of what you saw at Tricadia. And so, like, how did you make the decision to go from there to dv01? When did you start at dv01, and kind of how has your role evolved over time there?
Sure. Well, part of it, Tricadia was evolving from being a structured fund because the opportunity, the mortgage debt opportunity and the opportunity the senior felt wasn't as attractive as maybe corporate credit was at the time, which is a few years back. And I realized that I'd gotten a little bit pigeonholed myself into mostly focusing on the mortgage side, and I really wanted to understand better the whole gamut of consumer credit. Not so much understand because I've always had a fundamental grasp on it, but be a lot closer to the market dynamics of everything that was going on in auto, consumer, and various types of mortgages, including 2.0, where Tricadia, I think we were focused far more on the legacy side. So from there, I kind of naturally gravitated to the role at dv01, where I felt like it was a mutual kind of interest where I could learn the asset classes. And quite frankly, I also wanted to get quite a bit more stronger in my technical background, being able to kind of code, engineer, and understand languages, interfaces, cloud, all of that, because I felt like that was a natural evolution. So it's really kind of very mutually beneficial situation where I could learn the technical side from people who are much smarter than me on that, and I can lend my knowledge to dv01 and understanding how investors see these asset classes and how, what matters. So I think that's how that largely manifested, and I pretty quickly gravitated into the research role, which has been mainly my function for the better part of my entire tenure here.
Yeah. So consumer credit's been a really interesting, probably segment to study over the last 4 years, given the interest rate changes, everything that's happened in the overall economy, COVID, et cetera. Like, lots of stuff to research. What are you spending your time on now? And kind of what do you think the next couple of years have in store for us relative to the past couple of years?
Sure. I think at a big picture level, a lot of people in finance tend to think of monthly updates or quarterly updates because that seems to be the cadence. But the truth of the matter is, when we start to think about consumer behavior, that gets far more into psychology and mindset than it does something that you can quickly tangibly point to. Because the things that you can quickly point to is saying, okay, that's driving it. Those tend to self-correct pretty quickly. We see this all the time when we get a lot of investor inbound inquiries whenever you have a natural disaster like what we're seeing, unfortunately, in California right now, or what we saw in Florida a couple of months ago. And there's a lot of interest around it. Certainly behavior changes, but that change tends to take a course of 1 to 2 months. I try to think about things more longer term, and I think that what's not quite appreciated by the community writ large is that lending cycles, they tend to, a full end-to-end lending cycle, from going to tight credit to loose credit to maybe tight credit again, tends to manifest over the course of decades. The prior one, really prior to COVID, arguably lasted 20 years. You started to build up from 2001, 9/11 to 07 with the credit boom across all types of consumer credit. Followed by a massive contraction where people fundamentally altered the way that they interact with credit.
Right.
And that contraction literally never corrected until 2021, which arguably didn't even correct then. In some cases, 2021 was just the full buildup of a year of not doing anything, all happening in 6 months. But since then, the crisis end-to-end, net crisis, the credit cycle has only been about 2.5 years. We had ultra-tight credit in early 2020 because of COVID, coupled with lack of demand. Then we had, in some segments, ultra-loose credit standards. Certainly not 07, 08, nothing of that sort. But you certainly had some pockets of, and some segments of the market that saw a little bit of a proliferation of bad lending standards. And then you almost immediately saw that course correct in 2022. And it course corrected in a very predictable way, where you didn't have an exogenous factor like home prices falling 30%, where you could pretty quickly point to the fact that things were underperforming very much in line with a standard kind of credit cycle tightening environment, where you saw the weaker credit, the borrowers that don't have as much attachment to their loans in the event of higher inflation, which obviously was a big catalyst, really start to underperform. So it was very much a tail wagging the dog situation, where the underperformance at the bottom was so bad that it brought the average numbers up quite a bit. And so people would start to take sense of saying, oh, well, the averages are bad, but the averages weren't. It was just really bad performance.
It was based on segments.
Exactly. So in large part, what we saw the lenders do very proactively is start to tighten lending standards quite a bit earlier than you saw in, let's say, the auto market, where that process really started in late 22, early 23. I think in consumer, it started in early 22. If 2022 and 23 were some of the really bad years for the sector, then 2024 have turned out to be one of the best, if not the best. Except 21. We kind of exclude 2021 because it's such a conflation of everything going right on a macro level and at a level that you really can't replicate. So other than that year, 2024 has been exceptional for performance. So some of that is certainly a correction from how bad 22 and 23 was, but a lot of that is still kind of healthy, just credit performance. And that's what I think I've been focused on, is getting people to understand that the market is in full recovery mode, where I think some people still think that performance is trending down, which it certainly isn't. I think the narrative around consumers struggling with inflation continues to linger, even though macro data on consumers point to that not being the case. And I'm also really focused on how, in some ways, the consumer lending markets are leading the broader efforts. And we've started to see, for instance, on a macro level, we started to see credit card debt growth can slow down massively. Auto debt has slowed. And that's happening both at a macro overall level, and more importantly, where I've been spending a lot of my time is regional. We're starting to see real regional dispersion in performance, not to a level we haven't seen before. That's certainly not the case, but to a level that really matters for investors, considering that geography is not something that is typically considered in terms of price. Quite a few things. I think one of the biggest underlying factors is, unfortunately, something that isn't going to go away. It's the housing insurance crisis. And we do have several areas in the country. I think the biggest example of this for the next decade will continue to be Florida, where costs have so exponentially risen that it fundamentally alters the financial decision of existing homeowners and people in the state in a way that is going to take years to manifest, in the way that isn't something you can easily prepare for. As an existing homeowner, you can't prepare. There's nothing you can do if somebody says your homeowner's insurance premium is going up 5 times. The only option you have is sell and move out of the state, because everything in the state is facing that back. But whereas if you're a new buyer, you can think, okay, I'm buying a property that I'm going to have to pay this much for insurance. So I either have to buy that property materially cheaper, or I have to buy a different property. If you're an existing owner, especially considering some of the states it's happening in some of the oldest states in the country, and some of the areas where you see a lot of people own in cash, that's really a tough situation for a lot of people to handle, and that is translating to performance.
Yeah, and it feels like something has to give in California and in Florida with house prices too, because you can't have all the costs going up, and then the only thing that can give, and from my opinion, is home prices at some point, right?
Yeah, absolutely. And all of this is coming on the back of the fact that if 6 years ago we were debating, or 8 years ago we were debating if we had a housing shortage, today we're debating how many millions it is.
Right.
And when you have that kind of supply and demand imbalance, it will create all manner of confusing and kind of back and forth things around what's going to happen in house. Because like, we haven't solved this housing shortage. It doesn't seem like it's something that can be solved over the next year to probably most likely over the next decade it will be solved. So against that backdrop, yeah, we'll definitely have a push-pull factor around housing prices. And the interesting thing is, you mentioned the states of California and Florida. Those happen to be number 1 and number 4 in terms of the least affordable states in the country. Yeah, California being the lowest, and Florida being 4, but arguably 3, because one of the top ones is Montana. But again, Montana mainly because of just the unaffordability in certain parts of Montana, and it's a very small state. Right.
Interesting. I want to go back to your comment about you sort of view credit cycles over a 20-year period. And so if I think about 2001, ZIRP environment, very low interest rates for a long period of time. I also think there was really an explosion of data and ways for consumers to access credit. over the last 20 years? The rise of a lot of fintechs. You have national banks. You still have the very important community banks, credit unions, et cetera. Like, how do you view the relationship of credit became more available because of data, or how much do you attribute it to just the ZIRP environment, and we were in a zero interest rate environment for so long? And then how do you think that translate to the new world we're at, where we're not going to go back to a ZIRP environment? And so kind of big picture, what do you expect? Like, what do you see as the big drivers over the past 20 years? And what do you see as the big drivers of kind of consumer credit over the next 20 years as a result of this big shift?
Sure. I mean, that's a great question. I will put it this way. ZIRP, certainly, I think the ZIRP environment, what that did is it made investors have to start thinking about a different way of investing, or not being able to rely on kind of 10-year treasuries or standard fixed income in order to generate return. But I think once you open that box, I think it's open.
Right.
You know, we've already, or to put it another way, prior to 2001, if you were an investor and you said, I want direct exposure to U.S. consumers and their ability to pay, the answer to you would be tough luck.
Right.
You can't have it.
Right.
You can invest in banks on their credit card book, certainly. But other than that, there's no way.
Right.
2001 brought about, I mean, the non-agency, the private mortgage market had existed before that, had been existed since the early 90s, but not to the same degree, right? And then we had, you know, this rapid expansion of credit, in some ways powered by data, certainly, because some of the mortgage lending had been around for a while, but the idea of a synthetic tranche doesn't exist without digital lending.
Yep.
Right? Because how? Right? You have to put it together. You have to intermediate that information. You have to pretty quickly develop it. But that was fairly rudimentary. At that point, you were still talking about standardly underwritten mortgages into a database environment that investors can now access. Unfortunately, that obviously came with a lot of fraud and a lot of like bad participation on multiple segments, which I think is well documented. Since then, I think the idea that, hey, people still want to be able to lend directly to consumers, or investors want to participate in a way that's direct to consumer, I don't think that genie went back in the bottle. Mm-hmm. Some people got burned by the mortgage markets and never came back, no question. Some people will not come back. Some people will hear anything that happens in lending markets and scream subprime. And that, unfortunately, is something that's going to, as I said earlier, credit cycles take a long time. Right. We're still talking about subprime. For normal people, 2008 was 16 years ago, and for people in structured credit or these markets, it was last week.
Yeah, a lot of stress.
Yeah, people don't. It's hard to forget.
Right.
But once that was let out, and once people realized that, hey, with cloud computing, with the ability of accessing big data, you can push so many more data points around how credit decisions are made to investors to get them comfortable.
Right.
So in some way, I think that's the bigger driver, because ZIRP it's gone for the foreseeable future. But considering, you know, the bad credit performance that we saw in 22 and 23, I'm considering the massive drop off in origination volumes that we saw in consumer and secured, 2024 has seen a rebound.
Right.
We've seen volume growth. We've seen investors come back to the space. Even again with 10 years where they are and short-term rates where they are. Has it come back as much? No. I still think there's a lot for it to go. So I still think that in a lot of ways it's still very early stages in the market. Something I've focused on a lot in my research is talking about the spread between credit cards and consumer unsecured loans, because the typical loan is a refinance of a credit card. That's, I think, various forms of refinancing represent about 80% of unsecured debt, and I'd say credit cards represent the vast majority of that. So historically, the spread between what I would say the top and the middle grades, which are closely related to credit cards and credit cards, has been about 2 to 2.5%. It's normal. The payment is still probably larger on the consumer unsecured loan, mainly because you're refinancing in the 4 years. Credit cards are not meant to be you don't amortize out a credit card loan, whereas here you amortize in 3 or 6 years. Today, that spread is 7.
Right.
That's 3
That's
times what
huge.
it was. And the impact is so much that if you just took the annual savings that you would get, if every single credit card loan was refinanced into consumer unsecured, it would nullify the entirety of nominal consumer credit growth over the past 5 years among all but the top 2 income cohorts.
Oh,
So
interesting.
the bottom 80%, the amount of credit they've taken on over 4 years, would all be nulled to 0 if you just, refinance all of those loans today.
So why is
so
it not
clearly
happening? I was saying, why is it not happening more then? What do you think the constraint is?
Well, quite a few things. I don't think there's a lot of capital on the sidelines, but I don't think there's $1 trillion of capital that's ready to be deployed into consumer unsecured and take the bank's business away.
Right.
If banks were to do it, sure, but I don't think I don't think Bank of America is lining up around the corner to cannibalize their own credit card product for a lower APR consumer unsecured loan.
Right.
So there is vested interest. There's still going to be a lot of people that are going to say, "Hey, I'm not ready to scale it at that much." Why it's not happening? Again, consumer lending cycles are not quick. Credit cards are established. People use them for interchange purposes. People of all ages have them. Credit cards didn't latch on that quickly either. So in some cases, people think of credit cards as something, hey, it's in my pocket. I can swipe it. I have money now. Maybe they don't think about the debt side of it the way that maybe should or could. I think it takes time. And I think it's a marketing question. I think it's a question of getting that knowledge into people's hands. But most of all, I think it's financial literacy. Mm-hmm. I think post-2008, we really saw a fundamental move in financial literacy. And nowhere was that more obvious than Gen Z and millennials, who I don't think any age cohort has seen their financial situation altered quite as much as young people. And they've taken the lessons of '08 to heart quite a bit. So we're seeing that, and that certainly is manifest. And they're also the generation that's more digitally advanced.
Right.
But is it present everywhere? No. Is it present as much as should be? No. And there is obviously capacity for investors to participate into kind of, step into this market, not just on a whole loan buying basis, but even then on a, say, turning the consumer unsecured securitizations that we have right now, which are very much one-off from individual entities, into something like a credit card master trust concept,
right.
Which doesn't exist at enough scale at any lender that's holding on balance sheet that has the ability to kind of keep that funding note in order to fund it. If that were to be the case tomorrow, the market would be growing.
Right.
Certainly. But when we're talking about consumer unsecured balances in the tens of billions and credit card balance in the trillions, then, we're not still talking about the same scale.
Right. So what do you think, like, when you get questions from investors who haven't yet invested in the space, what are the main themes that they focus on and want information on?
Yeah, great question. I think the big thing, first of all, people always ask about the newness of the asset class. The
Yep.
first immediate question is, how does it perform in a bad environment?
Right.
And I tell them that contrary to the fact that the sector is pretty new, which certainly the case, there were loans in '08, '09. Lending Club and Prosper did make loans at that time. There were fundamentally different loans than they are today. That was the peer-to-peer lending side. Mm-hmm. So we do know what performance looked like on a very small amount of loans, but it's there. We've also seen the sector have, I think, 3 distinct periods of learning and growth. It's had 3 crises, what I think of since its emergence as an institutional asset class, maybe, say, 12 years ago. 2013, you really started to see that growth rate. I'd say the first one was 2015, 2016, which was entirely self-inflicted. When you have 70, 80% year-on-year growth across the board, and you have a lot of new entrants, and you've got a lot of marketplace lenders, you're going to have a lot of bad stuff happen. And that's exactly what happened. We had bad lending in 2015, 2016. We had more lenders shut down at that point than shut down during COVID or during 2022, 23 combined. Mm-hmm. There are lenders, circle back comes to mind, that don't exist anymore. 2020 was obviously the second one, and that was entirely not self-inflicted. And then 22 and 23, I think, is something in the middle.
Right.
There certainly were bad lending practices in 2021 on some segments. I talked about the weaker credit, doing what it did. But I think the combination of inflation coupled with soaring rates did a lot. And quite frankly, coupled with some really concerning financial literacy and financial media headlines around what's going on, despite the fact that the situation on the ground really wasn't that bad. So I think media hysteria also played a role,
Right.
in what happened in 22 and 23. And I think we're
Right.
largely past that now.
Right.
So in some ways, when investors say, I don't know what the sector performs like, I say, well, we do know what the sector performs like. When it, when it's self-inflicted, when it's not self-inflicted, and when it's something in between.
Yep.
That's certainly one question that people get. There's obviously the question of, can these companies go away? How new are these companies? What happens if they all stop paying? And why do borrowers pay on their loans? I don't think those questions will ever stop, but I do think the more investors that come in and the more mature the sector continues to be, the less
Right.
that narrative
Right.
still exists.
Right.
But that's certainly the baseline question. There are certain questions about data. There are questions about how can we rely on these underwriting standards? How do we rely on these grades? One thing I always point people towards in the research is just how effective issuer grades actually are in telling the performance story. Because if you comp grade to FICO, which obviously is a big component of grade, grade beats FICO in analyzing performance 11 times out of 10 and twice on Sunday. Because you see that big grades represent a much larger portion of the universe, but they perform just as good as like the top FICO score, which represents like less than half the amount of grades,
Right.
which I think is a really, really big indicator. But ultimately what investors can do, and those that are sophisticated do, is they re-underwrite the loans themselves.
Right.
They take the portfolio that they get, and they take all the attributes that are available, which number into the hundreds or the thousands, and they say, hey, this is where I feel like I can take a little more or a little less risk. The great
Right.
thing is you're given that transparency because you're given so much data.
Right.
There's not something hiding in the weeds.
And
So
you have
I think-
dv01 basically validating the data and understanding the data. And I mean, that's the value that you guys add as an organization, right?
Absolutely. That's why people come to us. That's why we happen. But I mean, I will say, like, could you do this on your own? You could. It'd be very, very, very difficult. But I am glad that dv01 plays this role of kind of the arbiter, not the arbiter so much as the transparency provider, and we ensure
Right.
that, hey, what you're looking at is good data, and you're seeing it consistently across the universe.
Right. I always think it's interesting
I-
from a transparency standpoint. Like, there's actually very little data that goes into Capital One's securitization trusts, right? I mean, there's not a lot of data that you can actually get out of those trusts and the data in those trusts. You go to a marketplace lender.
Not a lot. There's none.
Yeah. You go to a marketplace lender and you get everything, full loan tapes, data tapes. And so the amount of data available is 100 times what you would get out of a traditional bank and investing in traditional banks. It just takes work and understanding, and you're right, kind of conformity of understanding what that data means. And I think that's kind of the value that you guys bring. I keep saying that, but like that's what this industry needed when you guys started this business, 7 or 8 years ago.
Absolutely. And I will say too, as I said, when we think about the way that markets evolve, like, it's not quarterly. People make these decisions over years and decades. And in some ways, the structured credit markets are still fundamentally quite a bit smaller than they were in 2007, 2008. Not just the mortgage markets. It's well documented how much smaller they are. But
Right.
so much of the dynamism has gone away. The synthetic bonds that existed, the indices that existed, they're all largely gone. And I think that's a real disservice to the market, because in a lot of ways, there is the ability to get these kind of like, really solid returns on what winds up being very low duration product. In fact, if I would argue on a fundamental level, just going back to my investor days, riding out, if credit performance had been relatively normal, which of course it was okay at the top, but it was really poor at the bottom. If you had a relatively normal credit performance year in 22 to 23, would have been about the best fixed income product you could have lived in would be consumer unsecured. because
Right.
you didn't take a bath on your duration like you did in
Right.
mortgages or like you did in treasuries.
Right.
And you didn't have the fundamental questionable risk of what do you do with office properties and what do you do with, certain retail, and in some cases, what do you even do with like certain multifamily that you had in the CMBS market?
Right.
And yeah, you would have done quite well. You wouldn't have had to mark to market under duration. You wouldn't have had the interest rates kind of going sideways on you because you're already looking at loans that have double-digit GWACs, right? You're
Right.
not looking at a product where the rate doubles
Right.
in the kind of rate environment that we saw in 22 and 23.
Right.
So it would have been a fairly safe place for investors, truthfully. And I do think that today there's the marketing opportunity. There's the opportunity to say, look, we need to piece away at this behemoth that is the credit card. And we need to keep making interest rates lower for consumers because the mechanism of transiting rates today to consumers is easier than it should be easier than it was historically, but it's not. It boggles the mind to me that today credit card APRs are 600 basis points higher than they were in the late 90s, while 10-year treasuries are lower.
Yeah, you're right.
Short-term rates are lower, long-term rates are lower, credit cards are 600 basis points higher.
Right.
That's kind of the opportunity. That it's taking out that market share. It's the ability because if this market were to grow at that level, you have the ability to do variable funding notes. You have the ability to do indices, like real tradable indices. And I think that kind of dynamism is really still needed in the structured markets because it's such a way that American households differentiate themselves from, I think, other developed world households.
Yeah. Yeah, it's interesting. Well, just to get back to data, which is your core, and sort of kind of wrap this up, you talked about 3 different sort of consumer credit cycles since the whole kind of marketplace lending boom came. Clearly, you have a lot of people interested in the space. I know us and our peers are getting a lot more inquiries from investors, and there's definitely a lot more interest in participating in this. What advice would you give investors, banks, credit unions in terms of what to look for in the data to give them early indications that the market is either getting significantly better, it's getting too frothy? You talked about 2015. It was just way too frothy. Are there leading indicators in data that people should be looking at to try to get a sense for where we are in that cycle, or is that just too hard to predict?
Oh no, I on the contrary, I think it's really, really transparent and it becomes really visible when you're looking at it. The great thing about, I'll say dv01, but the great thing about the fact that there are so many market participants and all of them make not just their existing originations, but all their new originations with all the new transparency and data readily available. So you can pretty quickly see how new loans compare to older product, how new loans are performing versus older product, and how certain attributes or even certain layers of attributes are performing together. And I'll give you, an example. In 2015 or 2014, 2015, you could pretty quickly see the escalation of the fact that a lot of the new originations were happening not even in the mid-borrower FICO score range. That wasn't, that was certainly the case, but the market had always been mid, or it wasn't prime plus. It wasn't the area where you'd originate a lot of 800 FICO loans. But really what you could see is there was a lot of origination of those lower grades of Lending Club and the lower grades that we talk about right now in the bottom grades universe. That really started to ramp up. And you could pretty quickly see that average FICO scores were trending down, mainly because you had a lot of these loans originated at the bottom end. A lot of that being by new market participants who were saying, hey, I need to outcompete Lending Club, or I need to outcompete Prosper or Marlette, who are the bigger, guys at that time. And that pretty quickly manifested when you started to see the first dominoes fall with credit performance that started to get a little bit bad. And then you started hearing headlines, and they all came at the same time, right? You had the headlines, and Santander, who was a big buyer of consumer unsecured loans, had to sell their entire, portfolio.
Yeah.
2 months later, we had the lending club scandal, or we had not scandal so much, but we had the outing of lending club CEO. Right after that, we had Prosper with a situation where they had to be, bailed out by a consortium, and then we had Circle Back going under, and all of that happened in a period of 6 months. But even before that, you could see the credit quality change on a consistent basis. You could see how different the 2014 and 2015 vintages were to 2013. It was all right there. And a lot of investors either A, said, hey, you know what? I'm not going to play in the bottom grades. I'm only going to play in the middle and top. And they did fine. Because top grade loans, they did just fine.
Right.
Even in that time. And we saw the same thing happen in 21 and 22. The same exact thing. Where on the aggregate, you see the sector's aggregate FICO score go down, mainly because we were originating a lot more of these bottom and middle grade loans. And lo and behold, when the environment got a little bit tough, and when you started hearing headlines about maybe certain valuations weren't being met with a realistic expectation of future performance, all of that again happened and pretty quickly. And from there, you could pretty quickly see both origination volumes drop off and then also credit performance start to deteriorate. And that deterioration really concentrated in the bottom scores. If you look even one layer into the data, you could see the multiples of, you could see the multiple effects of how much defaults were. As a prime example of this, if you took as a whole sector, the CDR, the constant default rate, in peak 2023, I believe, peak late 23, was about double what it was in 2019. That seems really bad. But if you take top grades, which represent just over, on the aggregate, represent over 55% of all loans outstanding, and even a larger portion in 22 and 23. The difference in CDR from 2019 to 2023 was about 100 basis points, maybe a little bit less, maybe 1.2 times higher. Almost de minimis when you consider that interest rates were also higher. So on an ROI basis, you were the same. And bottom grades were 4 times higher. They peaked at almost 30%. So that's very much the case of, you can really see in the credit where it's happening. There's no black box. There's nothing that's like, oh, I don't understand what's happening in data. It's really right there.
So basically follow the data, but
follow the data.
The data's
do the legwork.
The data's looking better now than it was a couple years ago, right?
Quite a bit. Quite a bit. We saw origination standards really start to change in the first quarter of 2022. It just didn't translate to performance as quickly as you might have expected. So you would have expected maybe 2023 to be better than 22, but it wasn't. We didn't start seeing better until this year, or 2024. And I think that will largely continue in 2025.
Yeah, that's great. Well, Vadim, thank you so much for being our guest on the Consumer Lending Perspectives podcast, brought to you by Upgrade. And I really appreciate you taking the time and sharing your insights. And for those of you who haven't met with dv01, I highly encourage you to set up some time with them and learn more about how they can get you the data you need that Vadim said you need to make good decisions. Thank you so much.
Thank you, guys. Thank you for having me.
Thanks for listening to Consumer Lending Perspectives. Subscribe for more expert insights and strategies from finance leaders. And share the show with your network. Until next time, stay ahead in the ever-evolving world of consumer finance.